options there are for off-farm investments. That's kind of the overarching theme of the presentation. A bit about share market basics, which I think is probably a pretty good option for off-farm investments. I'll do a brief discussion on current sort of economic environment, and then there'll be time for questions at the end. If there's anyone who has any burning questions throughout the presentation, feel free to chime in and ask. I'm sure I can handle that too. So next slide. Thanks, Ali. In fact, skip through the disclaimer, which I've got to put in every presentation slide. So who Morgans are? So we're the largest full-service retail stockbroking firm in Australia, and retail meaning mum and dad investors rather than institutional investors like superannuation funds and that sort of thing. So most of our clients, we do have a small institutional desk, but most of our clients, about 95% of our clients are mum and dad investors, I guess. This slide's a little bit out of date. Over 35 years of helping to provide financial services to our clients. It's actually our 40th year. We're having our 40th birthday this year. We've got 61 branches across Australia, offering the full, financial planning and investment advice and stockbroking. We're a lead manager of fixed interest offerings, which I'll touch on, and if anyone has any questions about, I'm happy to answer later on. We've got an exceptional track record of corporate opportunities, with that being capital raisings and IPOs, which I'll go into a bit more detail. A long and proud tradition of putting our clients first. We're independent of large bank and licensee buyers, so we were founded by a handful of stockbrokers back in the 80s, and we've maintained our sort of independence since then. We've been through a few name changes. We were ABN AMRO Morgans and RBS Morgans and Morgans in alliance with CIMB, but now we're back to being just Morgans again and wholly owned by our employees. We've got a positive culture of evidence in our incredible staff retention rates. I've been with the company for 12 years now, and we've got an award-winning research team of 30 analysts covering 220 stocks, which spanning the breadth of the ASX market. Next slide. Thanks, Ali. So full service advice, I guess that needs a little bit of explanation. So I'm sure most people understand what stockbroking and financial planning are, and that's the crux of our business. But we've got these other parts which sort of complement that. So as I mentioned, our research team who essentially provide analysis of companies to invest in, and we as the stockbrokers or financial planners use that information that they provide to help make decisions for our clients. We've got a corporate finance team, which their clients are essentially companies looking to raise money, looking to list on the stock market, and I'll touch a bit more on that later on. Fixed interest is a growing part of our business, so most people will be familiar with fixed interest in terms of term deposits, but there are a lot of other options, including capital notes and listed investment trusts and the like. And then, as I mentioned before, a small institutional equities desk where our clients are fund managers and super funds. Next slide. Thanks, Ali. A little bit about me. This is what's called my advisor profile. I actually, did all of this, put all of this information in when I started as a trainee broker 7 years ago. So and I haven't touched it since. So take it with a grain of salt what's written there. But I guess a little bit more personally about me. I was born in Rockhampton and grew up in Chinchilla before attending boarding school in Brisbane, where I've lived for 20 years or so, short of a short stint in the UK in 2008, which is a pretty ordinary time to be over there because it was the credit crunch back then, but it turned into being the GFC, which was very unpleasant, but I had to do it. But before all of that, in high school, I used to pick melons in my summer holidays back in Chinchilla. And I was about 15. I saved up about $2,000, and Dad convinced me to buy shares instead of buying a guitar. I think I wanted to do at the time. So that was my first experience with the share market, and I've been in love with it ever since. I ended up studying commerce at uni because of that. I owned those same shares that I bought all the way until I actually became a stockbroker about 7 years ago, and I've sort of since then diversified, but I own those shares for 15 odd years. So I started at Morgans about 12 years ago as in an administration role, just a data entry type role. I actually applied for a job. They knocked me back because Morgan's knocked me back and said, we've promoted the guy in the dealing in the mailroom. Do you want to come back in and interview for the mailroom job? So I came in for a second interview, and they said, oh, sorry, we've gone with someone else for the mailroom. So I didn't even make it into the mailroom. But thankfully they did keep me in mind, call me back a few weeks later. I came in for a third interview similar to the first, and I got a job. I spent 5 years cutting my teeth, learning the ropes a bit, and then 7 years ago I got a gig as a trainee advisor, and I've been picking up new clients and providing investment advice ever since. Being from Rocky and Chinchilla, I've ended up with a lot of clients around central and southwest Queensland through Rocky, Emerald, Springshaw, and then in the southwest, Chinchilla, obviously, Gundawindi, St George, as far west as Quilpie. So I've got a lot of clients through regional Queensland, as far north as New South Wales, as far south as Victoria. As far north as Cairns, and as far south as Victoria. So clients all over the place, but mostly in regional Queensland. A couple of years ago, Simon Gleeson, who's my cousin, asked if Morgans wanted to sponsor, and I thought with my experience with regional Queensland clients, the two businesses fit well, so I was pretty happy to be able to offer something like this to Droughtmaster members. So that's me in a nutshell. Next slide, thanks, Ali. So under off-farm investment options, so you can cut the asset classes or the options that you have to invest in any way you like. But those four there in blue are, I guess, the traditional asset classes. Everyone understands property. Most will understand that you can buy property direct, or there are listed, ASX listed companies that invest in property as well. But obviously shares, you can invest in Australia or internationally. Fixed interest is a pretty broad asset class: term deposits, bonds, preference shares, capital notes. And it's a growing part of our business. Cash is obviously just holding onto cash or holding it in in a savings account. And then alternative assets I've put in red because I've never touched any of them and probably never will. Cryptocurrency and non-fungible tokens are all the rage at the moment, or they certainly were last year. These asset classes, there's never really a proper or a legitimate market for these types of assets, and I steer well clear of them. I've had countless calls, inbound calls from people wanting some advice on trading cryptocurrency and Bitcoin, and I've never touched it myself, and will never suggest anyone else does. So obviously, as a stockbroker, I'm going to talk mostly about shares. Thanks. Next slide. Thanks, Ali. So those four traditional asset classes, I've kind of done a graph of how they've performed over the last 20 years. This is real data that I took. I've kind of mislabeled the lines or the colours. So that the dark blue one is Australian shares, and that's returned over the last 20 years. This was done late 2021. Over the last 20 years, that's done 8% per annum. Australian property and international shares, those lines meet up right at the end together. So they've achieved about 6.5% per annum over the last 20 years. Cash is actually meant to be fixed interest, and that's like I said, a pretty broad range. There's plenty of different return profiles of the different kind of options there, but I've just put in a straight line of 5% per annum, and then CPI is inflation. So if you stuck your money under the mattress, you'd get 2.5% per annum on that. So obviously, shares, I think, are a pretty good asset class to invest in. They're the highest returning over the last 20 years, and you can pick any 20-year period going back more than 100 years, and that will usually be true. I mean, there's some periods where maybe some of the international shares might have outperformed, or property might have outperformed, but Australian shares have been a very good place to invest for a very, very long time. Next slide. Thanks, Ali. So what are shares? They're obviously more than just numbers on the screen, and this is something that a lot of people don't really understand. They just think the share market went up today by so many points, or it went down by so many points. But owning shares is owning part of a business. and the more profitable that business is, the more valuable the shares become. So if you've got a company that's growing its profits year after year, then the share price is going to grow year after year because it's a more desirable asset to own. And buying a share means you're buying a business that you think will do well in the future, and as a shareholder in that business, you have an entitlement to the future earnings of that business. So the earnings being the profits. Private businesses, managers of private businesses can do what they like with their profits. They can pay themselves a dividend. They can reinvest into new parts of the business or new products. The same is true of listed companies, but those decisions are usually subject to board approval, and for most, at least, mature businesses, part of those profits, anywhere up to 90%, will get paid out as dividends. So many new investors get concerned about the 3-digit codes and the daily and weekly share price movements. But if you're an investor in a business, then you've got to think like a business owner. If you owned a business and had one bad day or even a bad half year of sales, would you just go ahead and sell your business or sell your shares? No, you wouldn't. You've got to think with a long-term view, and all of the graphs and charts in this presentation are deliberately on a 20-year time frame, because everything's got to be looked through on a long-term lens. You don't buy property with a view to selling in 3 weeks' time, and similarly, good long-term investors in the share market don't do the same thing. If they buy and the share price goes down 10%, whatever it might be, in a couple of weeks, they don't lose their cool and sell at a loss. Next slide. Thanks, Ali. So the benefits of investing in shares are fairly straightforward, but worth spelling out. So as I've said, they've historically outperformed other asset classes over the long term. They provide long-term capital growth and can provide a strong and growing income stream depending on what companies you're invested in. The franking credits on those dividends provide a pretty tax-effective income for shareholders. The franking credit system is a little bit complicated. I'm happy to ask any questions on it, but essentially the dividends that you receive are already been taxed. So when you receive them, you don't need to pay your full marginal tax rate on them. You get a franking credit to the tune of 30%. Liquidity, you can buy and sell shares most business days with settlement due 2 days later. So it's obviously a lot more liquid than direct property, with 90-day settlement and that sort of thing. You can, if you need access to your money, you can sell and get your cash almost straight away. Next slide. There's one more thing coming up on the next slide. Go ahead. Thanks, Ali. The one benefit to people in the cattle game is the low correlation with the share market over compared to cattle prices. So this is the ASX 200, or the top 200 stocks in the Australian market, charted against the Eastern Young Cattle Indicator. So there's a pretty nice low correlation there. So if you own shares and you own cattle, or you're in the cattle market, there's a good chance that if one's going up, the other one's not. So it provides a pretty good hedge against what you're probably exposed to in your business. So that dark blue line there is the Australian market, and it's important to note with reference to the next slide is that it looks like we're only just back up above or pretty much to the level that the Australian market was back in 2007 before the GFC. But the next slide will show that's not actually the case. Thanks, Ali. So that dark blue line is the same one from the last slide, and then the light blue line is reinvesting your dividends. So that's called compound returns, and it turns something that's gone in the last 20 years. The dark blue line, you've made 100%, so you've doubled your money if you just invested in the share market. But if you'd reinvested your dividends, you've made 400% or 4 times your money. So that is that's the beauty of compound returns. And if you go to the next slide, that's something that Albert Einstein claimed was the 8th wonder of the world, which I like as a nice quote. So this is a pretty simple chart of if you'd invest $200,000 today and using that long-term return of 8% per annum compound, your $2,000 today would be almost $1 million in 20 years' time. Which is pretty incredible if you just reinvest your dividends, reinvest your profits into the same asset class. Next slide. Thanks, Ali. So a real-world example of compound growth, and I picked a company here that's been listed for more than 100 years. This is Washington H. Sol Patterson. The ticker code is SOL. Started life as a chemist in the late 1800s. Is the second oldest listed company in Australia in 1903. So it started in the late 1800s, but didn't list on the market until 1903. BHP, which everyone will be familiar with, was the first company to list on the Australian market. So Sol Pats has never missed paying a dividend in 116 years that it's been listed, and has increased its dividend every year for the last 20 years, which is quite incredible. So if you've been a long-term investor, you'd be getting more in dividends than what you paid for if you bought 40 years ago. And just a nice little comparison there of this company versus buying property. So the median house price in Brisbane in 1981 was $42,000. The median house price in Brisbane last year was $607,000 and change. So that's a 14.5% return, or 14.5 times return in 40 years. If you'd invested $42,000 in a company that was already 77 years old in 1981 and reinvested your dividends, that 42 grand today would be worth almost $9 million. So that is the beauty of compounding. This one's been a pretty impressive example of it. But even so in 1981, the compound annual return of 14.7%. So that's been better than the broader market average, but really quite incredible. Next slide, thanks, Ali. So a little bit of market information, I guess. So the secondary market is what's quoted on the news every night, and that's existing shares being traded between different investors. So there's a certain number of shares for each company, and they get traded on a daily basis. One investor wants to buy them, one investor wants to sell them, and that's what makes a market. The primary market is where companies actually issue new shares to either new investors or existing investors in the business, and that's the primary market. So part of our corporate finance team, as I mentioned before, they have their clients are companies wanting to raise capital, and they come to our clients and say, we've got a great investment opportunity, we're going to issue some new shares and either list on the stock market, or if they're already listed, use that money to grow into a new part of their business or do whatever they want to do with it. So if we go to the next slide, I'll show a few examples of companies that Morgans has helped to grow. So these are all companies that Morgans has brought to market via an initial public offer. That's IPO stands for, and listed on the stock market. Plenty of well-known names there. Definitely a Queensland bent to many of them, and some that will be well recognised. Horizon was a pretty big offer back when I first started at Morgans. Back then it was QR National and changed its name to Horizon, but most will be familiar with. Flight Centre, Telstra, Suncorp. And plenty that people won't be familiar with that have been pretty incredible winners. Lovisa is a fast fashion jewellery chain, which has gone from, I think, listed at $1 per share and is now trading about $16. That was only about 6 years ago. So this is the other part of our business, I guess. Apart from just buying and selling shares on the market, is helping companies to grow, and as investors, you get to participate in that growth. Next slide, thanks, Ali. So this is the returns of all of Morgan's initial public offers for the last 7 years. So if you'd invested $1,000 in every single one of them, you would have achieved an annualized return of 28.26% per annum for the last 7 years. So most of them have done very well and been made multiple times your money. And those on the left, obviously, there have been a few that haven't been quite as good, but if you just participate in every single one, you do pretty well. Obviously, I try and pick as many as I can on the left and try and weed out as many as you can on the right. You don't get them all right, but it's a pretty stellar return for companies that we've helped to list over the last little while. Thanks, Ali. So one of those businesses back on the 2 slides ago was Flight Centre, which listed on the 1st of December 1995 at $1 per share. Since then, they've paid a bit over $20 per share in dividends, and the share price is now $20. So that's a total return since IPO of 3,360%, or you've made 33 times your money if you invested in the IPO. And before the COVID crash, and back when Flight Centre was doing much better than it has for the last year or two, that $60 per share pre-COVID high, you'd made almost 70 times your money at that point as an IPO investor. So compounding really does work. And I've got clients who invested in that IPO, my dad being one of them, and still owns his Flight Centre shares. So a little interesting anecdote, the Morgans Branch Managers Conference in 1995, just before Flight Centre listed, one of the guest speakers was a futurist, someone who predicts what's going to happen in the future, and he said there are two jobs that won't be needed in 20 years' time, and those are stockbrokers and travel agents. And one of our founders turned to his friends and said, well, that's no good because we're a stockbroking firm that's about to list a travel agency. But how wrong that futurist was. Stockbrokers are still needed, I think, and Flight Centre is still going strong today. Next slide. Thanks, Ali. So the key question, I guess, is how to pick the right shares to buy. And the first message there from before is you're buying companies, not shares. But there are plenty of things to consider. I guess understanding what industry or sector that business is in, where we are in the cycle of that industry. So, I've come to the view that just about every industry is cyclical. I spent all of Thursday last week out visiting companies. One of them in particular kind of stuck in my head. Was a company called Big River Industries, which supplies timber to the building industry. And he says, and I've heard this before, and it's relatively true, is that the building industry is on an almost metronomic cycle of about 7 to 8 years from peak to trough. And every industry goes through cycles. None of them are completely predictable and saying it's going to happen every 7 or 8 years. But trying to understand where you are in the business cycle definitely helps in terms of whether it's a good time to invest or maybe you hold off for a year or two. How does the company make money is also one of the most important things, and are the profits growing? I generally invest in only profitable companies, occasionally a startup who's hoping to change the world, but more often than not, they end up falling in a heap. But I've highlighted in blue there, in dark blue there, that probably the most important one is access to company management. So in addition to seeing those companies, I took the whole day off on Thursday to go and see. I did a bus tour around Brisbane to see 5 or 6 companies. And we probably talk to the business managers of a dozen companies per week. I like to be able to ask them the pointy questions and see the whites of their eyes, but actually hearing it from the horse's mouth is probably the most important thing, and that's something that the general or do-it-yourself investors don't get. And because Morgans has such a big network of investors and stockbrokers and financial advisors, the company managers are eager to get in front of us and tell us about their business, and it's for us to decide whether we can believe them or not, and whether we want to invest in them. But I think from my experience, the key to investing in businesses is knowing the people behind them. Next slide, thanks, Ali. So how's the economy going? I deliberately left this slide pretty bare because going back to what I've been talking about over the long term, most of this stuff doesn't really matter. I mean, it's what makes headlines at the moment and what everyone's worried about, the outlook for inflation and interest rates, Ukraine and Russia war, COVID lockdowns in China, and the federal election coming up this weekend. It's what everyone seems to be pulling their hair out about. But if you take a long-term view, these things don't matter. For the last 2 years, everyone's been worried about COVID, and now no one seems to be even talking about it anymore. And the markets have just kept roaring on. So obviously, these kind of events have short-term impacts on the market. But as you'll see in the next slide, we tend to just forget about them in time, and they usually tend to be buying opportunities. I will give my 2 cents on each of these issues just for roundness. The outlook for inflation and interest rates, well, it was only 6 months ago that Josh Frydenberg was saying, I'm not sorry, Josh Frydenberg, but Philip Lowe, the RBA governor, was saying that we weren't going to raise interest rates until 2024. He's done a complete about-face and done the first rate rise. Economists are now saying that we're going to see interest rates, RBA cash rate at 3%, or between 2.5% and 3% by the end of the year, which would be the fastest interest rate rise since 1993, if it actually happens. But economists always end up being wrong and are constantly, readjusting their expectations. A nice quote there from Peter Lynch, Magellan fund manager, who said, if you spent 13 minutes analysing economic and market forecasts, you've wasted 10 minutes. He ran the Magellan Fund, which is not the Australian Magellan Fund, but this is a US fund from 1997 to 1990, and achieved almost 30% per annum compound return. The Ukraine and Russia war, just finishing off on interest rates, higher inflation, higher interest rates, the two biggest parts of the ASX, or the Australian market, are resources and mining stocks and banking stocks. And both of those industries tend to do pretty well in an inflationary and interest rate hiking environment. So I think our moniker as the lucky country will continue. The biggest risk for higher inflation and higher interest rates is in expensive tech, which has already been seen the last 6 months or so in the US particularly, and it's somewhere that I haven't been invested in, and I'm still not looking there just yet. Ukraine and Russia war has lit a rocket under commodities prices, which have seen share prices of mining and oil and gas stocks and coal stocks move much higher, much quicker than expected. But I still think that even with the higher outlook for inflation, those sectors of the market are good places to invest. COVID lockdowns in China. China has always been a bit of a black box in terms of what they're telling you. They print, inflation numbers and growth numbers, but you can never really believe what they say. It seems that every day now a new city in China is going into lockdown. It's certainly driving up inflation in the rest of the world, and whether that will be, well, I expect it will be transitory, but it's just going to happen for a bit longer than was initially thought. I read an article today which suggests that China is not going to change their zero COVID stance until they've got their version of an election, the Chinese Congress, later this year. They're not going to change their stance on any of this until at least that happens, when Xi Jinping ensures that he stays in power. So you can expect a bit more noise around the lockdowns in China for the next 6 months or so. And the Australian federal election hasn't as much an impact on markets as it normally would, I guess, in a quieter year, with those other three things going on being pretty big events. But generally what we see with elections is share prices, or the markets, tends to drift leading into them, because everyone's worried about what's going to happen afterwards, who wins, who loses. But generally what we've seen is after the election, no matter who wins, markets tend to rally, because it's the removal of the uncertainty that everyone's sort of selling stocks to, because they're concerned. As soon as that concern is gone, markets tend to rally. But we'll see how that pans out next week with all those other things going on. But all of that being said, next slide, thanks, Ali. All of these things, there's always been something to worry about, and that's what causes volatility. Volatility isn't a risk; it's an opportunity. Australian shares have climbed a wall of worry. This is going back to 1900. This graph on the bottom left here. Unfortunately, I couldn't find one that included the last couple of years with the COVID crisis. But these are all the major share market falls in brackets. How much they've come down. So World War II, the market went down 22%. The 1929 crash down 46%. There was a recession in 1990. The market went down 32%. We're still up and to the right and still growing. So the market really does climb this wall of worry. There's always negative market headlines like those in the top right, and deal or no deal in Brexit, and is there a recession coming? Over the long term, the market just keeps roaring on, and if you can invest sensibly and with a long-term view, you'll do pretty well. Not on that chart, but I've just put a note down the bottom right. the COVID-19 pandemic saw the Australian market fall 36% in a single month. And by the end of 2021, so less than 2 years later, we were 11% above the previous peak. So that's a perfect example of climbing the wall of worry. If a global pandemic isn't something to worry about, then I don't know what is. Next slide. I think we're almost at the end here, Ali. So I guess hopefully I haven't ended on a sour note there, but if anyone's interested and wanting to invest in shares, or you already own shares and you want some advice on it, this is kind of how the process works, and with the services that I offer my clients. So generally, if I'm taking on a new client, I determine their investment objectives, their time frame, their return expectations, their tolerance for risk, construct a portfolio based on all of that information. We buy the shares. We provide pretty regular market updates by email. I do an annual portfolio review annually at a minimum. Usually, there's something to talk about more often than every year. But at a minimum, a portfolio review, communication by phone and email for anything that's urgent that needs to happen. If something you need to buy or you need to sell a share, or at any time, I can always give you a call. 24/7 access to account information and research, monthly reports on your forecast income, your investment performance, and an annual tax report. I think I've just got a couple of examples of that on this final slide. Next. Thanks, Ali. So in terms of hands-on, what you can see and touch, I guess, regarding your share portfolio, that on the left there is kind of this is our model portfolio, just as an example. But you can see, what shares you own and how much you paid for them and what they're worth now, just by logging in to the Morgans website, using your own login. The two on the right there are examples of the forecast income report showing how much money is going to come into your account every month. And then the bottom one there is investment performance. And then the jewel in the crown, I guess, from the reporting side of things, is a tax report that you can give to your accountant at the end of each financial year, and that's got everything, all the tax implications of your investments, all neatly wrapped in one nice little report. I think that's about it. I think there's one more slide just with my contact details, Ali, but I'm happy to pause there, pretty much bang on half an hour, and take any questions.